Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending May 9th, 2025. And this week I'm titling the video, A Turning Point is Near, but what is the catalyst? And we'll dig into this and more over this next 15, 20 minutes. And I appreciate you all tuning in. I'm host of InvestTalk, Justin Klein, and I hope that you will like and subscribe to this channel and our podcast, Invest Talk. Now, let's go over first, what happened this week economically, and then we'll dig into the charts. Now, from a movement standpoint, there was some green, but a lot of red as well, and it was a modest up week, but kind of more of a pause, and it makes sense. We're at resistance, and I'll show you that here in a minute. But you can see here where the gains were, a lot of in the finance field. You definitely had a lot in names like Mastercard, Bank of America, J.P. Morgan, Berkshire. Interesting enough, declined, but you had some losses over in healthcare, and it looks like a new. I forgot his role, but Vinay Prasad is Stanford a Stanford doctor, Stanford trained doctor, and he's a bit skeptical in the way that drugs are approved, and it looks like it's going to make it more difficult for many drugs to be approved, which is not shocking considering JFK, RFK, excuse me, is head of HHS. So that continues more bad news for the healthcare space in general. And that really weighed mostly on markets. You definitely had some red over there on consumer staples. A lot of that had to do with rates going higher. So we'll dig into that. But in the tech space, mixed bag. Apple, Google down. Google bit really down because Apple is thinking about moving them out of the default browser on the Safari browser on the iPhone and replacing it with some AI, et cetera. And that certainly hurt there. So kind of a mixed bag, like I said, very flat day on Friday. And this is all about the meeting over the weekend in Switzerland, it looks like, between China and the US on trade. And the rumor is the US will drop the rates from 145 down to 50 or 60%. That would still be pretty high. But I don't think it would solve the problems that this is creating. It might help a little bit at the margins, but that's kind of the rumor here. We also have OPEX, and I think that's more of a catalyst because I don't really see major trade deals being done. The one that's been done is the UK, but if you look at pre the Liberation Day, shall we say, the deal isn't really better than that. Both tariffs on both countries are higher, and so I just don't see a lot of traction here if that's kind of the base for how these deals are going to go. So OPEX often though is a time of change and dealer hedging kind of comes unwound, and usually the current direction the market's going in, especially in a time of high volatility, it tends to go in the other direction. Doesn't mean it has to go back to new lows, but a pullback from 56 something on the S&P right now down to maybe 43, which I'll show you in the chart, is something that certainly is possible. So we'll look at that. But let's look at the economic data first. The ISM employment index, that did come in a little bit higher than expected, still less than 50. So net on the services side, companies are laying off workers, but less than they did in March. Okay, less than they did in March. The overall ISM services PMI did improve a little bit, 51.6. So that is still in growth territory, but not changing this downtrend that we've been in really since the fall. Okay, when it peaked out around 56. ISM services prices paid. This is where you get that stagflationary type of look here, where you have this breaking to cycle. Is this cycle highs? Well, the highest level since where are we? February of last year, or sorry, 2023. So over 2 years, the highest level in over 2 years. So inflation looks to be accelerating in the economy, not just on the good side, but the services side as well, which is really, frankly, the main source of inflation because services are where the economy runs and operates. About 60-70% of the economy is on the service side. Now, trade balance that did go down to, is this record lows? Yeah, record lows. And you can see this falling off a cliff. This is why the first quarter was a very bad or negative from a GDP perspective. It's because companies were front loading. They were seeing the tariff issue ahead, and they were saying let's stock up on inventory and not have to deal with these tariffs. And that's why you have that negative GDP print, because net exports are the last part of the C plus I plus G plus X. That net X is the net exports. That is the calculation for GDP. And so what you're likely to see, if I go over here, let me go to the Atlanta Fed, Atlanta Fed. Sorry about that. There we go, GDP now. So this is actually positive for the month, or sorry, for the quarter. I think we're at, what are we at, 2.2? Okay, sorry, 2.3, up from 2.2 on May 6th. And that is actually more positive than it should be, right? So the first quarter was more negative. It really wasn't a negative quarter if you back out those issues. But now this is going to rise considerably. This is going to have a big jump in the month of April. So something of note, and kind of understand how that GDP is calculated. Initial claims for unemployment. This is our weekly series. You get this kind of real time look, excuse me, at the labor market. That ticked up pretty nicely last week and then came back down this week. So kind of still remains in the range, not really breaking out to the upside. Continuous claims that did break out to the upside, but came back into range. So we'll see, do we stay next week in this range, or do we get a breakout? And that will be a good tell of where the labor market is headed. U.S. productivity in the first quarter, I want to highlight this because this is bad for corporate profits. When you have poor productivity, when you have tariffs dealing a blow to margins, that is all going to lower corporate profits, and corporate profits are correlated with unemployment rates. So one of the first things companies do when profits decline is they start to pause hiring, and then they eventually lay off workers. So something to pay attention to. You get the double whammy of poor productivity plus lower profits. That would be bad for the labor market overall. I wanted to highlight this. Now, China numbers are always notoriously a little murky, but exports, based on the reporting, did come in still positive in April, 8.37% year over year. That is a deceleration, but what's happening is they're taking a lot of the goods that were coming to America and just shipping them across the world. And you see that Chinese trade balance dipped down in April, but still nicely positive. So they're not falling off a cliff. And I don't think there's a lot of pressure for China to make a deal in the short term. Let's take a look at Bitcoin. We are at 104,000 right now. This is attempting an all-time high breakout, which was about 106 was the previous high. And so that is obviously a positive sign for markets if you are getting that positive move in Bitcoin, because usually that's a liquidity dynamics that typically drive this. We'll see if we get a breakout. What would be bearish if we get a breakout and then we fail rather quickly? So I'll be watching for that as well. On the Fed front, we did the Fed meeting on Wednesday. They didn't raise rates, they didn't cut rates, and they didn't really give any indication that they're cutting rates anytime soon. And that's why the odds of a rate cut, which a month ago was at 63% by June, is now down to 17%. And anytime this is below 20, that's basically the market saying, we don't think that's going to happen. Above 80%, that's pretty much priced in the market, and that is the Fed will not cut rates in June. Doesn't mean they can't start to lay the groundwork for a rate cut in June, but it's probably not going to come in June. The now modal outcome is a better than 50% chance there'll be one rate cut in July. Now, once again, a lot depends on economic news that comes in, and the Fed talked a lot about the uncertainty that's out there in the economy, and uncertainty of how these tariffs are going to fully impact inflation as well as the labor market. Now, the end of year, it used to be the most likely outcome was here, 32% a month ago, that it would be basically 4 rate cuts, okay, from 425 now to 325. Now the base case is only 3 rate cuts by the end of the year. And remember, there's only 5 more meetings. And right now, it's not likely to be in June, 1 rate cut. So then you're talking about 4 more meetings, and I think we're going to get probably less than 3. I think I land more here where you get maybe 2 and push towards the back half of the year. So it's kind of what I'm expecting for markets. Now, let's go dig into the charts here, and hopefully we can shed some light on what is happening. And here is the S&P 500, and we're back. What you notice here is we're still below all these major moving averages. There's this volume spike. See these blue bars? This is volume at price, so how much volume is traded each price. And if you can get above this level here, basically around 57.50 or so on the S&P, that could give you a clear move all the way up to, nearly 6,000 on the S&P. But OPEX is typically a time of market inflection. You see that here in February. That was a time where you had the OPEX, the third Friday of each month. That's here, 221 was that for February, and you had that inflection lower. And what you can see here is it often inflects a couple days before that Friday, because what happens is the what we call theta decay accelerates dramatically in those last couple of days. If you're not close to in the money, they basically become worthless, and then those dealers that are selling those options, they have to unwind their positioning, their hedging. And so if they are short calls, then they tend to sell off the underlying position. And with this bounce, there are a lot of calls in this market. And so they're going to have to start to unwind those in the back half of this week. And that's kind of what I'm expecting, more of a shift. We do have some big news, I think earnings out of Walmart and some more economic news in the back half of the week. Let me actually pull that up here and take a look at what next week looks like. There we go. So let's go to the economic calendar. Let's look at next week. And from what I remember, there we go. Wednesday, actually Thursday. Thursday's the you have existing home sales, Fed manufacturing, Kansas City Fed manufacturing. Friday, you have new single family homes. It's a pretty light week, actually. Nothing really on Monday or Tuesday here. It's a pretty light week for economic news. You don't get really anything until Thursday or Friday. So wouldn't shock me to see the market kind of hold up, meander around for the first couple of days of the week, and then you get a more of an inflection in the back half of the week. So that's kind of what I'm expecting. Let's run a fib real quick, and what you can see is the trough. You are hanging around that 618 retrace. 75, I believe, is up here around 5,800. So you could have some more upside in the short term to maybe the 5,800 level, maybe even pierce a little bit above this high here, right? Like I said, 5,800, 50, 5,850 in that range possible, but I don't really see it getting through there without a really positive catalyst around trade, around what happens out of with the trade talks this weekend. We're not hearing any news so far. And so that's kind of what I'm expecting. Now, does that mean you have to revisit the lows? No. I could easily see this kind of chopping around and filling this gap here. That's around the 5,300. Okay. So if I pull in, let's see if this wants to give me anything. There we go. So it'd be right here at this close. That would be that gap. Okay. That would be that gap right there. And so that's the area that I'm thinking will get some sort of support on the markets. Probably would be my downside target in the short term as we get more clarity on what's happening with the broader economy. So that's kind of my range for the next month or so. Is I do believe we get an inflection lower, but nothing that brings us to new lows or anything like that. Okay, now let's go and dig into some of the other charts here. Here's the NYSE, and this also at resistance, right? This breakdown candle, that's major resistance here on 19,500 on the NYSE, and certainly could roll over here and find some downside. Gold does look relatively strong. It's just kind of consolidating. We were overbought here. Sentiment was pretty offsides. And I said this, I think there's a Barron's cover that just kind of was bullish on gold, and that usually marks some sort of at least short-term high. And I think there could be some more consolidation in the gold market overall. Let's take a look at the VIX. The VIX has pulled back, but what you can see here is it's not making new lows. This is an upward trend in volatility, and another reason why I do think there's a good chance of some downside volatility in markets over the next couple of weeks. Let's take a look at the credit markets. So here is the CLOs. So I'll be watching this. This is in a downtrend. This is another thing where you're getting a downtrend in the credit markets, which typically feeds into the equity markets. And if I pull up that, as well as here's short-term junk to short-term treasuries, this also is hitting the 50-day moving average and easily could roll over especially if there's not a lot that comes out of this meeting with China. I definitely could see that weakening. Let's look at some of the sectors. The banking index did bounce once again, not doing anything positive. You have the broker dealers that did bounce. This is looking a bit better. This is probably the most bullish if you're looking at the finance space. It's definitely if it's definitely the strongest above the 100-day moving average. So these would be your Morgan Stanleys and Goldman Sachs of the world. And so the fact that they're strong is a good thing. Same with XLF. That's broadly positive. Industrials, that also is showing some relative strength here above all the major moving averages. You definitely like that. But technology below the 100 and the 200-day moving average. So the fact that that's not getting much traction above those moving averages does portend to more downside in the space. And obviously, the major indices are very overweight the technology industry. Let's take a look at utilities. Utilities are strong, so money continue to flow there. But I do want to cover the bond market. Okay, so here is the TLT, 30-year Treasury, long-term Treasuries. And what you can see here is you had the original Liberation Day little rally and then reversal. And you've had just a choppy, this is just bearish consolidation and could easily be breaking lower. If this breaks below 85, that's a big worry, and that definitely could be a catalyst for the next market sell-off. Here's IEF 10-year Treasury, obviously a bit better because there's less duration risk here, but it's not. It looks very similar, right? So if you continue to get the steepening of the yield curve and those long-term rates headed higher, that means higher mortgage rates, higher cost of capital, and it's more difficult for the U.S. government to finance their deficits, and that is a huge worry. So something I am definitely watching for. The real estate came in this week. You also had, what was the other one that came in? Yep. The consumer staples, that was weak on the higher yields. So something I'm watching out for as well. Let's take a look at energy. Energy stocks actually had a decent week, and that was with the news that OPEC was raising their output. The reality was OPEC cheats a lot. A lot of the members of OPEC cheat. And this just kind of catalyzed a lot of what the countries were doing that were cheating, meaning they were producing more than their quota, right? And so this really didn't put new supply into the market. And so you had that initial dip down and it quickly reversed it and gained. So I'm actually a bit constructive on the energy space, mainly because I think we're, around $60 per barrel for WTI. Shale just doesn't compute below 60 for most regions, and so I think there's a floor in the mid 50s on oil because these shale names will just shut down production, and it's pretty relatively cheap and really easy then compared to traditional wells to start and stop these oil wells, these shale wells, and so they'll just shut them down because it's just simply not profitable, and that's why I think this reversal in oil is definitely a big tell. On the currency front, you definitely had, let's take a look at the dollar first. So the dollar was stronger, a bit stronger on the week, but still in a broader downtrend. And then if you look at things like the yen, same thing, right? A little bit weaker compared to the dollar this week, but still in a broader uptrend. If this gets any more traction to the upside, that will definitely bring the potential for more volatility in equity markets. So I think we are at an inflection point, and what's the catalyst? Is it just OpEx? Is it the bad trade deal, or lack thereof? Is it some other economic numbers? CPI. Actually, I think CPI. I want to say is Thursday. Didn't show that on my chart, but from what I remember now, I think there is CPI later this week, so that could be a catalyst as well. So um, it's just a lot of things are lining up to say, okay, we're at a make or break moment, at least in the short term. It can mark a short term high in markets this week. Well, that about does it. Appreciate you tuning in and liking and subscribing to this channel, as well as our podcast, Invest Talk. And hope you have a wonderful weekend. And a reminder that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.